advanced solutions which we offer bundled around that repair solution to our range of blue chip clients. We operate across 13 countries. We've got just less than 4,000 employees. We have about 21 depot sites and a number of walk-in, about 100 walk-in retail sites around the world, predominantly in India, some in Mexico and Spain, where repairs, simple repairs, can get done prior or instead of going back to the depot. Our business is about 50% mobile phone, 25% media and entertainment, by which we mean set-top boxes and TVs, and about 25% B2B or business electronic devices, in particular ATMs, chip and pin machines, and medical devices. Our clients are, to a man, large, typically global blue chips, operators of cable networks, mobile phone networks, OEMs, the manufacturers of electronic devices, and to some extent insurance companies and retailers. I think you've got a snapshot of the business there. A little bit of history of the recent share price performance, and indeed, just dealing with the technology here a little bit. I think we've got that working out. Very good. Here's a little 2.5-year look back to during the current tenure of the existing board. The board was changed in March 2011 on a wholesale basis. I became the executive chairman, and we brought in a group of new non-executive directors and set in June 2011 a new strategy for the business. That strategy, very simply, took the fastest growing and highest margin parts of our business and focused our activities upon those. And those are the emerging market activities of our depot repair division, and then the advanced solutions activities, which are a new range of services, not including repair, which sits within the depot business, but including software diagnostics, a certain amount of consulting, and refurbishment, e-commerce, and insurance-based activities. The first year of our tenure was principally focused on cost-cutting and turnaround activities to align our infrastructure and our management with the new strategic goals. We produced some good results at the end of 2012, showing about a 24% increase in overall operating profit, made up of some growth and growth in operating profit from cost cutting. And since then, the shares have been quite substantially re-rated as a result of improving results and a number of acquisitions during the course of the last 18 months or so. That perhaps brings us to a look at the financial highlights. I'm not going to go into a great deal of depth here because Job will take us through some more details, but it's a scene setter for some operational comments. If you look down the left-hand side of this slide, you'll see the blue columns are 2013 results that we're reporting here. The green columns are last year's results, and the copy in pink is a range of growth rates, with the last year's growth rates in brackets. I think the thing to take away from this for us is we've achieved good levels of growth in excess of 20% all the way through the P&L lines, 28% for revenue, 22% for headline operating profit. And across the board, those are growing rates of growth. So for us, this tells us we're at the beginning of something, not the middle or the end, and indeed brings the changes between the end of the turnaround phase of this development and the start of the growth period. I'm pleased to say that translated extremely well into operating cash flow, with the conversion from operating cash flow into from operating profit into operating cash flow of in excess of 100%, and that in turn translated into a reduction in debt. So, as I say, having set the scene financially, let's just look at this matrix. Some of you may have seen this before. For those of you who haven't, I'll take a moment to describe it because it's sort of a management tool for us to measure our progress, and I'll explain it as we go through. But across the top, you can see the countries that we operate in, 13 countries. Down the side, there are 10 service lines, which are our service lines within the business, and indeed the sectors you can see further down the vertical. The area described in green is the business that we were running at the 6-month or the half-year period 6 months ago, and across in a square indicates a service line in a territory. And there are 30 of those service lines, well there were 30 6 months ago. And today we have added in pink a further 15 X's. So an X at the very minimum is a client in a service line with a contract in that territory. And for many of these X's, particularly the green ones, they're multiple clients with multiple contracts and represent significant lines of business. I think the encouraging thing about the progress that you're seeing here is that, at least by one measure, there's a 50% increase in the scope of the business as a result of the last 6 months' activity. About half of that's organic and half of it's by acquisition. Now, don't read into that we've increased the revenue by 50%. But what I would say is that with the addition of a service line in a territory comes, this opens the door for additional revenue. Clearly, it's easier once you've got a first client in a service line in the territory to bring a second and a third. So the pace of progress is rapid, and we feel quite encouraging here. I think one other comment about scope and potential is today we're looking at a business that's got 220 million of run rate revenue in it, and is defined of the extent of this matrix. So that's our universe. As you can see, we've got about somewhere between a quarter and a third of those potential matrix points filled out with X's. We genuinely believe that within the scope of the existing business, there's a business 3 times the size of the one that we're looking at today that's readily achievable within service lines that we're experts at and within countries that we already have a physical presence and management team in. So one of our tasks, and indeed a measurement of that, is how rapidly and how well we're filling out this matrix. Clearly, so good progress in the last 6 months operationally. If I turn back for a moment to financials and look at the thing from a helicopter point of view to introduce what Jog has to talk to us about later on, I think what you're seeing encouragingly is that profits being driven by the 2 strategic areas of our business, so the emerging markets and advanced solutions areas of the business. That represents over 80% of our operating profit. And given they're the highest growth areas of our business, clearly as they become an increasingly large part of our business, we're benefiting from increasing rates of growth coming into the P&L. So the performance financially was encouraging, was particularly encouraging when you look at it against some of the headwinds that the business sustained during the course of the year. For anybody that knows about the mobile business, and as I say, mobile is only half of our business, but anybody who knows about the mobile business at the moment, it's clearly been a difficult time for a number of OEMs out there, whether it's Nokia or BlackBerry. It's all very well publicized, but they've had shrinking market shares. And to the extent that their volume of devices are shrinking, clearly we've got less to repair. And those underlying shrinkages have been overcome by good sales and new business wins to achieve the sort of levels of growth that we're seeing. So pleasing on that basis. In addition, we've got large businesses in emerging markets where the pound is appreciated against those currencies, so we've had to run a little bit harder to hit the numbers. And very finally, as additional profitability has been given up by the P&L through growth during the course of the year, we've reinvested with a view to 2014 and 2015. In particular, management strength and breadth has been added to during the last particular quarter of 2013, and during the whole of 2013 we invested in 1 or 2 lines of new business which should turn to profit in this year. And of course we've been busy doing some deals which we'll talk about a little bit later. Picking up a couple of operational highlights, I think for me the most encouraging thing was to revisit some of the deals to be 12 and 18 months ago, and discover the level of success we've had in bringing sales synergies into those. And I'll talk about those a little bit later. And in addition, to see the successes that the sales force have achieved. When we came into this business in 2011, there really wasn't a sales force in it. There certainly were a couple of salespeople, but it would have been somewhat ground thinking to call it a sales force. During the course of 2012, we built that into an EMEA sales force, and during the course of the last 12 months, expanded that out to a global one with an APAC sales office and an Americas sales office. So we genuinely have global representation to match the footprint of our global clients. And you'll see in the section below, which I won't go into in a great deal of detail, we've had some significant successes in new business wins, in particular in the second half of 2013, and I'm encouraged to say that that has continued in the first quarter of this year. In fact, the rates of growth are up quite substantially in the first quarter. The first 3 months of this year have seen larger levels of new business wins than the company's ever seen in its past before, and actually a multiple of where we stood a year ago, so quite encouraging. John, take us through some highlights on the financials.
Thank you, Matthew. So I'm Jog, I'm the CFO. I'm going to run you through some very basic analysis on the profit and loss account, the balance sheet, and the cash flow. I'm on slide 8. You can see the revenue has grown by 28% in the period. Of that growth, 12% of that growth was organic. You can see the headline operating profit, which is one of the key metrics that we look at, has also grown by over 22%, and of that, 13% of that growth was organic. We've had some acquisition costs in the period, and during the period we've acquired 5 separate businesses and formed partnerships with 2 others, and that's the reason for those sort of costs. And if you look at the other profit lines, we've also managed to grow them as well. One of the things to point out is on our tax line, we are able to benefit from a number of different things structurally. That means we have a reducing tax charge, which puts us at a very significant advantage against a number of other corporates. Particularly, we are able to benefit from something that the government have put in called Patent Box, which allows us to claim a 10% corporation tax rate on all our UK and global earnings that relate to R&D. And we're also able to benefit from being in lower tax jurisdictions like Poland and Romania, which means we've got a falling tax rate, which is a good benefit for us going forward. If I turn the sheet to the balance sheet on slide 9, we have 21 sites. We have over 3,700 employees, but this is not a capital-intensive business. You can see that the balance sheet net assets is only 39 million, and that's all it needs to be. The business has no off-balance sheet liabilities. We don't have any pension liabilities off-balance sheet. We're not in countries that are expensive to get rid of employees, and we also haven't got any onerous property, leases, etc. All very flexible. So the main investment that we focus on, the other items that are started on the balance sheet, which is our tangible fixed assets. So that's things such as basic warehouses, benches with bums on seats, and then the key investments in our working capital line. And I'll start them. Then our stock, our debtors, and our creditors. My model is to make sure that the creditors finance the debtors, and you can see they more than cover that. And also during the period, you can see that we've managed to improve our creditor terms and manage those better, so we got a benefit from that. And then the only other key investment is in stock, which represents a component stock that we hold to repair the mobile phones and set-top boxes, and that encompasses electronic equipment and screens and keyboards that go into the devices. And to only hold 8 million of stock across 21 sites is telling you that we turn our stock quickly, and our stock holding is only 20 days. So it's a very light balance sheet. Our return on capital employed in this business is very significant. I work at our capital employed as 5 million, which gives us a return on capital employed of nearly 200%, which is pretty special in my view. That means that we are able to grow and grow quickly. Typically, when we open a new site in a new country, if we do it organically, we get paid back in 12 months. If I turn to the next slide, on slide 10, which is the cash flow statement. This is a very simple reconciliation of the opening net debt with the closing net debt. We ended the period with 1.9 million of debt, which isn't very much at all. Our total facility available to us from HSBC is 23 million, which that means we've got significant headroom within our existing borrowing facilities to go and do accretive deals, go and grow organically or grow through M&A, and that represents another good growth opportunities for us. I'll talk about some of the main movements on the cash flow during the period. You can see the larger green blobs of the cash we've generated in the period from profit. You can see our cash conversion for the period is 116%. We generated more cash out of our business than the profit, and that's come through managing our working capital very tightly. That is a permanent improvement, but I don't think it'll be 116% going forward. The level of cash conversion that I'm targeting going forward and have been achieving for the last few periods has been 80 or 90% conversion, which I still believe is a very strong conversion, bearing in mind the business is growing at 28% a year. You can see that we actively manage the working capital. You can see the larger red blobs on the right-hand side of the sheet. We mentioned acquisition of HDM and acquisition of Landella. These are two deals that we've done in the period. HDM was a business that we acquired in Spain, in Mexico, and Argentina. The business in Landella was an acquisition that we made of a set-top box repairer in South Africa. Typically, when we're buying businesses, we're only paying somewhere between 3 and 5 times earnings multiple. And given that we're trading on a 12 times, 13 times multiple today, you can see that sort of M&A means it's highly accretive for our shareholders. The other thing to point out is on the CapEx and R&D, £4.3 million invested. So we're reinvesting nearly 50% of the profit back into the business for future returns. So to give you an example, on the capital expenditure side and tangible fixed assets, we're investing in new warehouses, which we've grown our facilities, new benches and technical equipment. We're also investing in R&D and intangibles, where we're doing research and development to help us grow our business and create new technology to be sold in future years. If I turn to slide 11, which is the divisional performance, this is how we measure the business in the segments that we report. A lot of data on this slide, and I'll pick out 2 or 3 different points. The emerging markets division is our sites like Turkey, like South Africa, and new for the period was Latin America, where we got 10 months contribution from the acquisitions that we did. You can see good growth in the revenue and the profit, and you can see that the margin is also very high, 10%. We like the emerging markets because the margin is good. The reason the margin is good because there's less competition out there. We also like the emerging markets because they're high growth territories. We're in countries like India now, in Latin America, where these countries have emerging middle classes that are all buying mobile phones and getting satellite TV, and as a result, we've seen good growth in the amount of work we're doing in those territories. The second division is the Western Europe division, which encompasses our sites like the UK, like Germany, and new for the period of Spain. You can see that there's also been good revenue and profit growth in the period, but the margin is historically lower. That's a structural issue. The margin in Western Europe is lower because there's more competitors there. In the UK, for example, we have 3 competitors, and therefore we're not able to price as aggressively. We have to do the work for a lower price point. But that doesn't mean it's bad business. The return on capital employed in Western Europe is still over 25%, which represents good business in my mind. The third leg of the business is the advanced solutions business. This is not depot-based. This is more IP-related work. So to give you an example, we have launched an insurance business in the period where we sell mobile phone insurance in countries like Poland and Sweden. The other example of the advanced solutions business, where we provide a solution to our customers, for example, Orange, whereby we would help them take a second-hand device from a customer who's trading in an iPhone 4. We would help them by taking that device back off them, polishing it, repairing it, making it look like new, and help them redistribution that device into a secondary market, for example, for students, or in a secondary market in one of the emerging markets such as Poland or South Africa. You can also see that the overall margin of the business looks like it's declined, but I think you need to just note that we've had a number of startup cost investments in the advanced solutions business, which has temporarily depressed the margin. But our long-term expectation for advanced solutions is a growing margin, normally at 15%. We expect that to grow further. I think that is on the divisional performance, and I'll pass back to Matthew to talk about some of the acquisitions.
Very good. And we're going to talk about two acquisitions. I've picked these because they represent the two sides of the business. As a bit of background, we have divided our acquisitive efforts between two corporate development directors, one of whom is focused on depot-based acquisitions around the world where we're looking to add services or geographies. Those are fairly traditional M&A activities where we're buying revenues and earnings. We've got a well sorted out formula for that, and indeed a well sorted out integration process afterwards. The second focus of our activities is more advanced solutions, technology, and new processes, where what we're doing is taking a fairly flexible approach towards venturing and partnering in order to bring those new activities into the group, into the sales bundle, offer them across the sales platform, but not kill the entrepreneur or the entrepreneurial spirit. And so we've had to use some structuring around those sort of transactions. I'll give you an example of those. Here we have the first deal I want to talk about, which is a company called Digicom. It's a transaction we closed about 4 weeks ago. I'm very excited about it. The Indian market is a very rapidly growing one. It's clearly a huge market. There are 1 billion people there. Mobile phone penetration is very low. It's about 5%. Interestingly, PC and laptop penetration is higher, with about 10% penetration. This business was built up around the PC and laptop business, and hence its largest clients are Dell, HP, Lenovo, and Acer. 3 of those are not existing clients for the group, so they're a terrific addition, and we've got a high level of confidence and indeed experience having picked up new clients as a result of that acquisition and then rolled them out through other geographies. So that's quite an exciting opportunity for us. In addition, we believe that we will have a mobile operation up and running in India within the next few months, and we're already talking to 1 or 2 of our existing clients about taking on their mobile repair operations in India. The main business, the depot, is in Bangalore. India is a very large country, and logistics aren't entirely easy. So around the country we have some 90-odd walk-in centres where people can get low-level repairs done within a retail-type environment. The business is growing extremely quickly, as is the market. It's growing at 30 to 40% per annum. We think that we'll be able to at least sustain that and probably increase that rate of growth. And I'm expecting to be able to tell you in a year's time that we will have bought this business on approximately 5 times EBIT. So what we can do is to take the market leader, which this is, and indeed continue that level of growth at that kind of purchase price multiple. We'll be very happy. The revenues don't look large, particularly for a country of this size. It is pretty extraordinary. There are 2 factors. One is this sort of business is absolutely in its nascency in India, but 2, also our prices charged are a function of labour cost, and clearly labour is quite cheap in India. But an exciting deal. If we turn to the next slide, something very different here. Those of you that will have followed us will have heard about our set-top box diagnostic capability. I'm not going to talk about that today because we don't have time, but we do have a diagnostics unit, and this business and the revenues from it will go into that unit and will enhance our diagnostics offer. Diagnostics is absolutely a cutting-edge and new area of interest, in particular in mobile phones, where there are all the businesses, and there are 4 or 5 of them globally, are all pre-revenue or just at the start of revenues. What this does is an app that will sit on your phone. It will run through 70 diagnostic tests. It's extremely smart, and will tell you what is wrong with your phone and what you need to do about it. In the US, we believe this will avoid 60% of the current level of phones that are going back to the depot, So it's somewhat cannibalistic of the traditional repair business, but it's a high margin and very interesting business. Every single mobile in the world will go out with this kind of diagnostic technology on it within the next 2 years. So there's a very large price. We'd expect the pricing for this to run somewhere, and there's a pretty wide range between 25 cents and $1.25 a device. And clearly there are hundreds of millions of devices out there. What we've done in recognizing the risk and the profile of this and the fact that we're a publicly quoted company, is put in a relatively interesting structure. We've bought a 15% stake for a modest price of just over $1 million, $1.2 million. We've taken an option to acquire a further 10%, which we'll exercise when the business becomes profitable. That will give us a minority interest and something that will be reported as a minority. Clearly, we believe that could become quite valuable. Perhaps more interesting in the meantime is that we've taken a gross profit share, and it's significant, by which I mean somewhere between a quarter and a third of gross profits on all deals that we help them ink, and that will go through our main P&L. It will always be a positive number, obviously, and we think we've got something here which, well, we've been working with the business over 6 months and we found a very high level of interest in our clients, which has made the selling conversation easier. We're probably 12 months away from material contracts, but in addition to the offer that we have to make. I'm going to turn very briefly to wrap up to some conclusions and outlook. As you'll have picked up from the relatively bullish things that we've said, trading is good and it's in line with expectations, which are for significant growth. Our new business wins are progressing well, probably better than we thought, and run rates are ahead of prior periods. There's lots of opportunity both for organic and acquisitive growth. We see that growth coming in the strategically important areas this year of emerging markets and advanced solutions. We will, within these numbers, continue to invest for 2015, so capital expenditure remains a significant number, and importantly we're going to grow the management bench strength, having cut it 2 years ago, now in line with the growth of the revenue in order to make sure that we've got the resources to manage these acquisitions, their integration, and the continued good operating performance of the business. The dividend is up, as I mentioned, substantially ahead of consensus. It's as a reflection of the board's confidence that we're on to a continued stream of good performance. And looking further out over the next 2 to 3 years, with the investments that we're making now, we believe these sort of current levels of profitability, these current levels of growth remain available to us, and are expecting some continued success of that. So thank you very much. As Hannah has said, there's an opportunity to ask questions now. And if you'd like to use the toolbar on the right-hand side and put some questions to us, Jog and I will try and respond to them.
So we've had 2 questions already. So the first question we've had is, which countries do you foresee as entering in the next 2 years? I can answer that. We got active searches out in a number of territories. We're very light in South America at the moment. We've only got 2 businesses there, one in Mexico and one in Argentina, and we're looking heavily at other South American countries such as Brazil and Colombia. When we're looking at countries, we look at focusing on countries that have a growing GDP and enough of a population to support a depot of the sort of size that we need. The other countries that we're looking at where we're light is in the Far East, where we haven't got very much at the moment. And again, we've got active searches in a number of territories. For example, we're looking carefully at Vietnam, looking very carefully at Indonesia. But as you know, these processes take a while, and it's quite tough to do M&A in those countries. But we have got 3 full-time people looking at that. I'll let Matthew take the second question, which is a question about who are our main competitors.
In terms of the main competitors, the world really divides in 2 between the Americas and EMEA. In EMEA, we probably have 3 significant competitors, and they're all private companies. They're reasonably sizable. We believe this year that we would just become the market leader in EMEA, but there are, as I say, 2 or 3 companies which are of a similar size. They are not, by and large, as profitable as we are. They certainly don't have the cash flow or the access to funds that we do, and we've been winning very material market share against them. If you're interested in doing a bit of research on your own, I'll mention some of the names. There are 2 French companies, Anovo, which is A-N-O-V-O, and SPE. They have something of a handicap in as much as they have very large workforces from legacy businesses in France, about 1,000 employees each, and that has they're not profitable businesses in France by and large. It's just too expensive in France to do this sort of business now, and clearly the employee liability associated with that number of employees is a problematic issue for them. There's a Dutch-based company called Telecom. It's a very good company. Fortunately, we don't compete very head-on with them. They don't do mobile, but we do compete in the set-top box area. And there's one other company which is UK-centric, which is owned by Unipart, called UTL, which we wouldn't see as a particularly strong competitor because of its domestic standing. Over in the US, there are a couple of larger companies that are part of larger groups. We occasionally come across them in Europe. They're principally EMS providers, or electronic manufacturing service providers, in particular Jabil and Flextronics would be the two names I mentioned. Frankly, we like our competitive position. It's one of the reasons we're succeeding at the moment. About it. They're all good competitors. So hopefully that helps you with that. Joe, what else have we got?
We've had a question about the infill testing from Virgin. So the question is, it's not the infill testing with Virgin has not been overhyped for traders' optionality. Please can you give us an update on the progress? I'll cover where we are with Virgin, and then Matt can cover the US. So we rolled the IFT out with Virgin Media. We started that rollout in January. The rollout has gone well. Almost all their engineers now have that with them, and that's over 1,000 boxes out in the field, and they're using them on a day-to-day basis. The rollout has gone well, and then the initial feedback from Virgin Media's end customers is very positive. In terms of the impact on the results, there's probably not quite a full half year's impact in the results because it was very much in rollout mode, but you will see further growth in that from the annualization of that rollout in the 2014 numbers, and it's good business and it's high margin. I'll let Matthew cover the update on how that is going in the US.
Yeah, sure. So we've been in a pilot program in the US for some months. We have a very large telco that we're working with in the US. I think it's probably fair to say that decisions there have been slightly slower than I personally would have liked, but perhaps understandable given the size of the corporates that we're dealing with. These are quite big contracts in the offing. I'm expecting some movement on that towards the beginning of next year, and indeed, hopefully we should be able to report some additional pilots coming in at that sort of time as well. We're making progress, particularly in South Africa and a little bit in Europe on that as well. So watch this space. Our view on the opportunity there remains the same. I think the questioner has helpfully said that we've not overhyped the thing. I think it's good to be prudent. We haven't built large numbers at all into our view of this year or indeed next. So there's some optionality around it. I see there's a question here about Hanover. I'll try and answer that. The question is, with Hanover having exited its holding in Fairpoint, is it reasonable to assume that Regenersis might be considering acquisitions of a greater scale than would need existing shareholder support? There's somebody thinking laterally out there. Actually, that isn't the case. I'm not going to rule out doing something larger for Regenersis, but that's certainly not where we're looking at the moment. I think there's some very good pickings in bolt-on deals. You should view the exiting the Fairpoint, if anything, as being related to the fact that there's actually quite a lot to do at Regenersis, and the opportunity is pretty special. So nothing more than that. Finally, there's another question here. So fine, there's probably a few more coming in, but at least on this sheet. Is it proving easier to attract new management as the share price and market cap appreciates, or is it simply a reflection of increased standing in the industry? I'm sure it's both of those, actually. We're clearly enjoying some success at the moment on a number of measures, and that is to say the industry as a whole. I would not say the industry is full of highly talented people, but there are some, and we've stretched a little outside the traditional area of the repair business to get the latest recruits. Jog and I are new to the industry. I think that brings some fresh thinking. We wanted to bring in people that know the industry but not necessarily tainted by the ways of the past. So we brought in a senior person from a car phone warehouse, which in and of itself is a great company, I think. House, a super guy. He's not yet started, although he's certainly actively in communication. I think it's going to be a good addition. Simon Harper started just this Monday. We've worked with him in the past, and he is a very talented and smart guy. He comes from HTC, so he's from a client side, and with a consulting background from Booz Allen in turnaround or change management, transformational change. And he's got stuck in. Yes, so we've got people coming to us at the moment, and I do believe we're building a standout team in the sector, and that's got to be good for us.
We've had a couple of questions, Matthew, about BlackBerry and how that affects us. Particularly, are we worried about them declining or not? I can answer that. I mean, we work with all the different players in the market, all the different OEMs. We also work with operators, so companies like Vodafone and Telefonica. We're not heavily exposed to BlackBerry at all. We principally repair for them in one country, and we've already seen declines in that revenue during the last 12 months, and we've been able to deal with that by replacing that with other work, either from other OEMs or from operators. One of the ways we're moving our business towards now is focusing more on operators. So if we focus on, pick a company like Vodafone, then at that point we're agnostic. Vodafone, or whether they sell Apples or Blackberries or HTCs or Nokia, we can repair all of those. So thank you for that question.
Yes, I think it's probably worth saying that of all of the OEMs, we are probably most underweight BlackBerry, which does sound like a stroke of genius. It's actually just a dint of history. So we're not immune from the shrinkage in BlackBerry, but we have less than our share of that. And as Jog says, we've taken the pain of that over the last 12 months. I've got a question here from David, which is what's the long-term target revenue mix for mobiles and the impact of RIM BlackBerry issues? I think we talked about the RIM BlackBerry situation, so let me address long-term target revenue mix for mobiles. The mobile industry is the largest business in electronic consumer devices, so it should rightfully always be a large share of our business. It's currently 50%. I would expect to see that decline as a percentage of the whole. But that will be as a combination of growth, but hopefully faster growth in some of the other areas. But I would say you have to go some to outstrip what's going on in mobiles, particularly given there's still rapid growth. I don't have a crystal ball, so I can't tell you how it's going to pan out, but certainly I would like to see a slightly better balance between the various parts of the business, just to the sort of stability of the earnings in mobile has proved to be a little more volatile than we perhaps like. So I think you should see that as a declining segment, but only as a result of it us growing elsewhere.
And I think that's it. That's all the questions we've had. So thank you very much from me for listening, and appreciate your time.
Absolutely, and for those of you, the shareholders, we appreciate your support. And I think you probably know where to find us. If you have any further questions, either come back to Equity Development or ourselves, and wish you a good day. Thank you.